Well, 2023 has been a year of rebounds for some beaten down assets. Bitcoin perhaps the most notable, but with inflation, rising interest rates, and the growing fear of the US defaulting on its debt, is the tide about to turn? A great time to speak with Mike McGlone, Bloomberg Intelligence Senior Macro Strategist. Good to have you on the show here. So we mentioned Bitcoin, one of the best performing asset classes by return year to date, along with gold. So you have your traditional safe haven and something that at one point was considered digital gold or a digital safe haven. Break those down for us, starting with Bitcoin.
Well, Rachel, I think it's important to note that virtually all risk assets have been up this year. Bitcoin is one of the riskiest, and some people call it the fastest horse in the race. It's up the most, but it looks like it ran into a wall resistance around 30,000. It looks like risks are tilted now towards the downside, particularly if the stock market starts rolling over. Yet gold's the opposite. Amongst commodities, it's the significant major commodity that's up on the year on a 12-month basis. It's up about 10%. And you look at the Bloomberg Commodity Index on a 12-month basis, it's down 24%. But I think what you're seeing happen is deflation in commodities, most particularly fossil fuels like crude oils, down 40% on a 12-month basis. It's fueling inflation for gold. Yes, we have this budget crisis. But I think the biggest risk now is as we tilt towards recession, that gold continues to outperform most assets and including Bitcoin, unless we get that stock market to take off, and that's kind of counter to what I think the Fed's wanting.
So to that point then, what do you think is going to be the next catalyst? Does it have to be a Fed pause or a Fed pivot in order to really see a catalyst here?
So the catalyst, I think it's already kicking in, and that's copper. You probably didn't expect that answer, but copper has a very high correlation, at least for the last 5 years, with the stock market. Copper has broken down. It was up 12% in the year. It's the metal considered to have a PhD in economics. It's broken now. It's down almost 2 to 3% on the year. And it looks like it's heading lower. That's typically an indication for risk assets, for the economy, and for the stock market. So if the S&P follows that, which I think it will, I think gold's going to continue higher. And Bitcoin is very risky. It's, cryptos are the riskiest assets. Bitcoin's just the least risky, is more likely to follow copper, I think, in this case, as we tilt towards recession. Now, as far as a pivot from the Fed, that's priced in the futures market. What's unique about it is most economists say, and even the Fed says, we're not going to be easing in this year. Yet the futures have priced for it. So I think one way for that to happen is for commodities to continue to deflate, which they are, and the stock market to roll over. That might force the Fed's hand a little bit to they've already stopped tightening, to potentially ease by the end of the year.
Another commodity to watch, we're taking a look at oil over the past year, down almost 40%, about 38% so far. What are we seeing there? Because we know there were issues when it first came to, the tail end of what we're still seeing with the Ukraine crisis. And then obviously you have things like summer oil, summer blends and things like that. What are some of the things that you're noting in the oil market right now?
It's a bear market. One thing to remember about crude oil is it peaked in 2008. Last year, it just bounced to a lower high, and it looks like it's rolling back over to that bear market. So it had a bounce in the bear market. I see crude oil, WTI, more likely to head towards about $57 a barrel. $57 a barrel was the average price from 2019 before we kicked in this massive liquidity pump that was related to COVID and the war. And there's a good indication for that happening. Natural gas has already done that. Natural gas's average price before it pumped up to around 10 was around 2. Now it's dropped to 2, it's bounced. But natural gas is the most significant measure of heat, electricity, and fertilizer in this country. And crude oil is significant, but as the world tilts towards recession, I think the way I like to say it might be irrational to expect demand increase on a global basis with the U.S. heading towards recession. So I see WTI in a bear market more likely to continue heading lower, following natural gas, and in this case, kind of in sync with copper, which has been breaking down recently.
And I have to ask you about Home Depot. Obviously, when you look at some of the deflation that we saw in lumber prices, weaker consumer demand, when you look at it as sort of a bellwether of commodities, some of these other home builders, you have all these commodities sort of built into the business. What is that telling us right now?
Bear market. I'm glad you mentioned lumber, Rachel, because it's not a significant commodity, but it's a good indicator. It's dropped to the same price that it first traded in about 1990 after that massive pump last year. And it was one of the biggest rabbits in the bull market, and the rabbits have collapsed. Natural gas is a more significant rabbit that has also collapsed. I see the dominoes falling. Copper last week broke down in the year. Crude oil is breaking down. Sugar is one of the few that's up, but it's not significant. And there's only one outlier. All that deflation we're seeing from commodities is keeping gold inflating. I think that trend's going to accelerate, particularly as we tilt towards a recession.
All right, great stuff. Thank you for your insights. We do appreciate you joining us. Mike McGlone there, Bloomberg Intelligence Senior Macro Strategist. Thanks so much.